Good afternoon, everybody, and welcome to the Allianz conference call about the wonderful world of accounting. Our topic today is IFRS 9 and IFRS 17 at Allianz, and we have scheduled about 1 hour for the call. Before we start, let me do the usual housekeeping and remind you that this conference call is being streamed live on allianz.com and YouTube, and that a recording will be made available shortly after the call. If you want to ask a question after the presentation and you join us via web call, please click on the Talk Request button at the upper right-hand side of your screen. And if you join us via telephone, please press *5. All right, that was all from my side for now. And with that, I turn the call over to our CFO, Giulio Terzariol.
Thank you, Oliver, and good afternoon and good morning to everybody. Today is not about the quarterly numbers when we usually meet. Today is about accounting, and we decided to keep the presentation from a pure technical point on a higher level, but we are providing also some quantitative information. The information is illustrative. What does it mean, illustrative? I would say it's informed illustrative, so clearly the numbers that we are disclosing here are supposed to provide some sort of guidance how you need to understand the profitability and the numbers of Allianz moving forward. So if we go to page 4, I would say the following, that we view this change as a positive. From a pure number point of view, we are not going to have significant changes, so the solvency clearly 2 is not impacted. From a cash flow point of view, there are no major changes or no changes, at least not in the short term. The dividend policy is not changing. Operating profit, net income are going to be basically at the same level. The ROE is going to be a little bit higher. So fundamentally, anyway, there is not a significant change, but we believe from a disclosure point of view, there is definitely a benefit because we think there is more transparency, especially on the life business, and this can give a better appreciation of the value creation. There can be some complexity at the beginning. As always, when there is a change in something, there is some complexity coming with it. But I can tell you, I remember when I learned US GAAP many years ago, and I was going through the white book, which was about 500 pages. There was a lot of complexity there too. I would even argue that from a conceptual point of view, IFRS 17 it's easier compared to US GAAP. There is some technical complexity, more on the accounting side when you do the booking, the posting level, but from a conceptual point of view, I would even argue that IFRS 17 is easier compared to US GAAP. We just need to get clearly used to this kind of standard. But fundamentally, we are excited here about the introduction of this accounting standard. Now, if we move to page 5, we should keep in mind that it's not just about IFRS 17, it's also about IFRS 9. IFRS 17 is clearly the new standard for the insurance liability measurement, but we have also IFRS 9, which is the new measurement for the asset side. Clearly, for an insurance company, ALM is critical, so assets and liability have to talk to each other. So from that point of view, the implementation of IFRS 9 is clearly also dependent on how the liability is moving. That's very important to understand that these two accounting standards have to talk to each other. And now if we move to page 6, starting from IFRS 9, you can see that about 80% of our investment portfolio is in fixed income, including loans, and evaluation basically here is still evaluation at fair value, with the majority of the changes going basically through the balance sheet, OCI. So there is just a small portion where we have a fair value with changes going also through the P&L. On the equity, we have evaluation fair value for the balance sheet, but basically the changes in the public equity are going through the balance sheet, so they are not reflected into the profit of the company. In the case of the non-consolidated funds, there is no other way to account for them that not through the P&L, so it's a fair value, and that's a fair value through the P&L. And then we have real estate and participation. In our case, most of this category goes through the P&L in order to achieve a better matching with the liability, because basically most of these assets are on the life side. In the case we have these assets on the property casualty side, there is more an inclination to use the amortized cost. So that's in a nutshell how the new accounting standard for the investment works. If we go to page 7, we can see what are the implications for us. You can see that in the current IFRS, we have about 6% of our assets or investment portfolio classified as fair value through P&L. In the new accounting standard, this number is going to be 18%. If you run the math, we are talking of about 100 billion of assets, which are going to be fair value through P&L. Now, the majority of these assets are going to be in the life side. So from that point of view, there is a mirroring or a matching with the liability side. So this is not creating accounting volatility, but we have a good 10 billion of additional fair value assets through the P&L in our property casualty segment, and these 10 billion of additional fair value assets through P&L are going to create some amount of volatility moving forward. Otherwise, for the rest, I would say there are no implication for basically the way the P&L or the volatility of the P&L is going to be. That's on the IFRS 9. Now moving to page 8, coming to the liability side, I would say that in a nutshell, the technical liability are going to be more similar to Solvency II. There are some differences sometimes in our case also in the scope, because not all entities are part of Solvency II calculation. There can be some difference in the contra boundaries. There can be some difference in the discounting rates. But fundamentally, we are talking of two frameworks which are very similar. So I wouldn't say they are twin brothers, but they are not twins, but they are definitely siblings. So from that point of view, that's a little bit of a simplification, because now we are dealing with a framework in IFRS, which is definitely getting very close to what we have under Solvency II. Also in IFRS 17, there is a risk margin, similar to what we have in Solvency II, and the overall level is similar, slightly lower under IFRS 17, but basically almost at the same level. And then we have the CSM, the contractual service margin. The contractual service margin is basically the present value or the future profit or the future enforced profit. And if you want, this would be part of the own fund under Solvency II. There is a difference between the own fund of Solvency II and the CSM. I'm going to come back later on this, but fundamentally think about this like future profit coming from the enforced business. And then we have the equity position, which is clearly the sum of the paid-in capital, the return and profit, and also there is always an OCI component there, which is much smaller compared to this OCI component that we had in under IFRS 17, because there is a better matching between assets and liability. There are also some new items which are allowing to get to this better matching, and that's something that I view as a positive, because we are going to have less volatility under Solvency, under IFRS 17 compared to IFRS 4 with respect to the equity position. Now coming to page 9, and we can get here into some numbers. You can see that currently means at the end of 2021, our shareholder equity was about 80 billion, and now when we run an illustrative calculation where we are as of beginning of the year, the shareholder equity is closer to 60 billion, is a little bit higher than 60 billion, and the main driver for the difference between the 80 billion and the 60 billion is basically the movement in the OCI. If you remember, we had about 17 billion of OCI, with a lot of OCI coming from fixed income. Now, due to this better matching that we have under IFRS 9 and 17, clearly this big OCI position that can also go negative, as we saw in the course of 2022, is basically removed. So from that point of view, the major change is coming from the OCI. As you remember also, when we are doing the ROE calculation, we have always excluded these OCI components because there was just clearly noise, not really reflecting what could be a more, if you want, core kind of equity. Then on top, we have the CSM, which is about the level of 35 billion. This represents the CSM that we actually think we are having. So that's a little bit of a view of the current level of the CSM. And this is a number which is after tax, because the CSM that you see in the balance sheet is pre-tax, so that's an after-tax number. And also here for the calculation of the CSM, we have deducted the attributable costs which are not included in the CSM calculation. So in the CSM calculation, the standard tells you to include only the direct cost, but in reality there are additional costs that have to be considered to measure the profitability of the contracts, and we have deducted these attributable costs from the calculation. So when you add up the 60 billion plus the 35 billion, you end up at 95 billion of what we call comprehensive shareholder capital, which is, if you want, the sum of the paid-in capital, the return earnings, and also the future profit that we expect to get out of our life business. This number is also close to what we have for own fund under Solvency II. If you run all the kind of adjustment, you're going to get to a number which is very close to the Solvency II own funds. And then one final comment on the leverage. Overall, the leverage is 23%. The leverage is here calculated, summing up the shareholder equity and also the CSM. This on the capital side. Now we move to page 10 on the operating profit. Overall, the operating profit is expected to be at the same level that we have right now. There is in the short term some upside coming from the fact that rates have gone up. But this is more like of a short-term impact. Over time, in reality, the profitability between the old accounting standard and the new accounting standard on the property casualty side shouldn't be, in reality, much different. It's more of a profit pattern point of view. So fundamentally, same level of profit with some additional profit in as we are seeing higher rates right now. The old IFRS would have catch up to these higher profits over time anyway. And now moving to page 11 on the net income. Also, the net income is expected clearly to be on a similar level. Here again, we had the operating profit with some aside in the short term. The non-operating items, we might see in reality a little bit higher non-operating items or coming from the other position, but that's more of a technical issue and it's not going to be extremely material, but we might have a little bit of a lift there. But in total, I would say the shareholder net income is going to be close to the level that we have right now. What we're going to see is more volatility coming from the point I was mentioning before, which is the market value change of the assets which are going through the P&L. And to this point, clearly, in the future, we are going to also provide an adjusted net income, which is going to remove for the volatility coming from the fair value through P&L assets. And this is going to be also the starting point, clearly, for the calculation of our dividend. So just expect that as we are going to officially introduce IFRS 9 and 17, we are going to provide also an adjusted net income, which is going to exclude these market value changes, and maybe we're going to do also some other adjustment, but we are still thinking about the final calculation. And with that, we can move now into the segment, going to page 13, starting from the property casualty segment. As you see, basically, almost the entire business has been accounted using the premium allocation approach. When you look then at the insurance liability, they are very similar basically to the insurance liability that we have under Solvency II. And the difference between this insurance liability and the insurance liability under the old system is basically the discounting, which is usually leading to, clearly, as long as the discounting, the rates are positive, is going to lead to a lower level of technical reserves compared to the current level. What is important, the valuation curve is locked in, which means somehow the balance sheet of the liability side works a little bit like a bond. Right now, where you had the swings due to rates level changes in the balance sheet, but what you see in the P&L is basically the locked-in effective interest rate. So that's very important. Think of a liability as the opposite of a bond, and the mechanic is basically the same with swings in the OCI and the current income, if you want, flowing through the P&L. The risk adjustment is also calculated in IFRS 17. It's a little bit lower compared to the risk adjustment that we have under Solvency II. Here we need to consider that in theory, implicitly, there is some risk adjustments included in the unearned premium reserve. So fundamentally, if you consider the entire balance sheet, one could argue that the amount of risk adjustment is similar under Solvency II and under IFRS 17. The equity is basically the same level as the equity under IFRS, current IFRS, if you adjust for the OCI. So once you adjust for the OCI, there is no real difference in the equity under IFRS 9 and 17 versus the equity that we have in the current accounting standard. Now moving to page 14, coming to the underwriting results. Maybe I give you first the baseline, the way we have estimated the 3 billion of current IFRS underwriting result is basically taking our 9 months profit and annualizing the 9 months underwriting results, and then we rounded the number down, so we get basically to this 3 billion. And the difference between this 3 billion and what we're going to see under IFRS 9 and 17 is coming from the discounting, where we expect to have based on the current rate level, to have 600 to 900 million more profit coming from the discount in 2022. I would say that based on the rate level that we are seeing right now, the number could be on the high end of this range. Then we had a loss component, which is in reality a number which very close to zero, can be slightly positive or potentially also slightly negative if you see a reverse of it. There is not really much happening there. And the same applies to the risk adjustment, is also a number that can create some noise, especially if actuaries sometimes get a little bit creative, but fundamentally there is not much happening because of the risk adjustment. So overall, I would say a higher underwriting results compared to what we were used to in IFRS 4, and that's coming from the discounting. And clearly this level of higher underwriting results is a function of the amount of interest rate that you have in the system. Now coming to page 15 on the combined ratio. The combined ratio is expected to be at the same level, little lower, but I can give you, first of all, maybe an idea how the combined ratio works. First of all, set aside discounting. Let's forget about discounting for a second. We need to think that the calculation of the combined ratio is a sort of gross net calculation, in the sense for the denominator we are using the gross earned premium, and for the numerator we are using claims expenses, all these kind of things, but fundamentally is a net view. So that's very important. There is the denominator is based on a gross view, and the numerator is based on a net view. This means that by definition, as long as you have a positive underwriting results, the combined ratio is going to be higher. And in our case, I can tell you that this makes about a good 50 basis points of higher combined ratio, just because of going from the net view that we have right now to this gross net view. Then clearly you have the impact coming from the discounting, and this can bring the combined ratio to a lower level compared to what we were used before. I did some math for you, and I tell you that we need to have about 70 basis points of discounting in order to get to a combined ratio which is equivalent between the current IFRS and the old IFRS. So that's important. There is a mechanic which brings the combined ratio up, and then you have the discounting who is going to bring the combined ratio down, and depending on the amount of discounting, you might have a lower combined ratio. Technically speaking, if you have no discount at all, because rates are at zero, you might end up even having a higher combined ratio compared to what we have been seeing so far. The expense ratio is going to be lower compared to what we have under the current accounting. That's because of the change from the net view to this kind of gross view. So we're going to see an expense ratio which goes more towards the 25% level. And with that, moving to page 16 on the investment results. Here also the proxy for the investment results, we have used basically our investment results for the 9 months, and we have annualized this number. And I would say under the new IFRS 9 and 17 approach, the investment income coming from bonds, equity is pretty much the same in the balance sheet, in the P&L, but then you had the reversal of the discounting, so the unwinding of the discounting, and this is clearly a negative number, which is about 400 to 600 million in our case. So this is bringing basically down the operating investment results compared to what we have been seeing so far. So when you put all together, in page 17, we have a higher operating insurance service results subject to the amount of interest rates. The operating investment results, it's lower because of the unwinding. In this situation, the unwinding is going to be stronger. The discounting has a larger impact compared to the unwinding. So from that point of view, there is a higher profit under IFRS 17 compared to IFRS 4. IFRS 4 will just catch up over time. So fundamentally, this is just bringing some profit up front, but fundamentally the IFRS 4 will just catch up over time. So there is not really then a change eventually in the amount of profit that we are going to book. That's on the P&C side. Now coming to the life side, starting always at page 19 from the balance sheet. Here we have the present value of future cash flow, which is basically the discounting of the expected cash flow to policyholder and also of the attributable expenses. So again, here we are not including all costs, but just the costs which are attributable, directly attributable to the policy. So that's a little bit of a difference compared to what you have in Solvency II. Then we have the risk margin. There is not much of a difference at the end of the day between Solvency II and IFRS. And then we have the CSM. I believe at this time you are kind of familiar with the CSM concept, but maybe the best way to look at the CSM is to think about a policy at inception. So if everything goes according to plan, the premium that we get, they should be higher compared to the cash flow that we give back to the policyholder. So the difference between the premium that we get and the cash flow is a positive number. This positive number under Solvency II will be own funds. Under IFRS 17, you need to store this positive number in the CSM. You're going to release this number over time. But think about this as basically future profit, which is stored, and then there is a mechanism to release this profit into the equity over time. That's the reason why it makes sense to look at the equity and CSM together, and this will be also a representation which is basically consistent with the Solvency II logic. And now moving to page 20, here we have the movement of the CSM. Basically 55 billion is more or less the CSM level that we would expect to have currently. We have an increase in the CSM coming from the new business. That's about 4 to 5 billion. Can be also potentially higher or lower depending on the profitability of the business and also depending on the volume. But we think that 4 to 5 billion, and maybe the upper end of the range is the expectation that we should have under the current condition. Then we have a positive impact in the CSM coming from the expected in-force return. That's on the one side, the unwinding. There is an unwinding clearly of the CSM because you need to think a balance sheet is always discounted, so you need to unwind back the position. And also we get some additional return because in the calculation of the reserve, we are basically using a valuation rate which is lower compared to the yield that we really expect. So from that point of view, there is always a benefit coming from the passing of time and the fact that we expect to get a higher yield compared to what is considered in the valuation rates. Experience and assumption changes. Here we have potentially changes from actuarial assumption, changes coming from the variances of the year, also economic changes. Fundamentally, these numbers should be in average zero. Clearly, sometimes it's going to be positive or negative. We might see some volatility coming from the economic variances. We would not expect to see a lot of volatility coming from actuarial or from operating variances, but this item can clearly be volatile because of the market development. And then we had a CSM release, which is in the amount of 4.5 to 5 billion, which is basically how much of the profit which is stored in the CSM gets released into the profit every year. Now you end up basically to a CSM, we said, of 54 to 60 billion. If you take the midpoint, it's 57 billion. And indeed, we would expect the accrual of the CSM, if you want, to be about 2 billion per annum. But here we want to reflect the fact that there is volatility around this number subject to market condition. Now, as I was saying before, the CSM is calculated before the attributable cost. So from that point of view, we think that from an economic point of view, we need to reintroduce the attributable cost into the calculation. And the CSM is also a pre-tax and then also a pre-minority number. So when you adjust for attributable cost, taxes, and minorities, you end up with a CSM, a net CSM of 35 billion if you take the midpoint, which is the number that you saw before. So that's on the development of the CSM. And now moving to new business. Here we are providing the reconciliation of the new business that you are used to see when we do our disclosure every quarter to the new business based on the IFRS 17 logic. We start from 2.5 billion of VNB. That's basically, if you want, the annualized number that we expect for 2022, rounded down to 2.5 for the sake of simplicity. Now we have to add back tax and minorities, because under IFRS 9 and 17, basically the number that you're going to see is before tax and minorities. There is some difference due to the risk adjustment calculation and also to a different valuation curve, and this explains then the IFRS VNB of, let's say, 4.5 versus the 2.5 that you have under Solvency II. And when you look at the new business margin, we start from a 4% new business margin under the VNB Solvency II logic, and under this IFRS 17 logic, we will be more at something between 5 and 6, with clearly the majority of the impact coming just from the fact that the view is pre-tax instead of being after tax. There are a couple of other items which are minor that explain the difference between the VNB and what is the CSM at inception, but we are speaking of very minor items. So fundamentally, I think this gives you a good idea of the reconciliation between the different level of VNB, and again the major driver is basically the fact that the calculation is on a pre-tax basis versus being after tax. When we go to page 22, speaking about the P&L, we can see that the P&L consists of the following item. We had a CSM release, which is expected to be between 4.5 and 5 billion. That's supposed to be a very stable number, so we are not going to see a lot of volatility around this number, because the volatility coming from economic conditions is going to be in the CSM. But it's going to clearly over time be reflecting the release of the CSM. But fundamentally, since we are speaking of volatility, in reality, things markets go up and down. So fundamentally, the CSM release is going to be stable. Then we had the release of the risk adjustment. This number is also supposed to be stable. On the loss component and variances, that's also a number that should be stable. Attributable cost is also a stable number. And now we come to the investment results, which is relevant for the entities where we don't use basically the VFA approach. So let's say Allianz Life, for example, is a company for which this line item is relevant. Here we are going to see some volatility. This volatility shouldn't be higher compared to the volatility that we see right now. Potentially, it could be lower, but I would be cautious to say that. We're going to see how this volatility plays out. But that's the only item where I would say we're going to see some volatility moving forward. But again, that shouldn't be much different from what we saw so far. One thing I want to say right now, where we're going to do the disclose the numbers next year regarding IFRS 17. We need to consider that in IFRS, when we do the hedging at Allianz Life, we are doing the hedging based on economics, statutory accounting, and also IFRS 4. Now, so the hedges that we have right now, they are geared to stabilize the IFRS, the current IFRS to a certain degree. So we were going to do the restatement next year. We're going to see clearly liability moving according to IFRS 17, which is not necessarily the logic that has been used from a hedging point of view. But so we're going to see some more volatility in 2022 compared to the volatility that we're going to see then once we go live with the numbers in 2023. So that's on the life side. And now we come to basically the end of the presentation. As I said at the beginning of the meeting, the fundamentals are basically broadly unchanged. Solvency II is clearly not impacted. Cash flow, they are not impacted. We might see down the road some more cash flow That would be once Asia is going to implement IFRS 17, that could be a little bit of a positive, but it's not going to be that material, but that could be a positive for us. Dividend policy is not changing. Operating profit, net income, as I was saying before, they are basically the same level. There is a little bit more volatility coming from IFRS 9 that we are going anyway to remove by showing also an adjusted net income. The shareholder equity, including the CSM, it's about 95 billion. This number is close to the Solvency II on fund, and also we expect to have a little bit of a higher ROE. And the main item then for me is also this improvement, in our opinion, the disclosure, where we think that on the life side, especially once we are going to see the pattern over time of the numbers, you're going to get a better appreciation for the profitability of the life business. It's going to be also easier, in my opinion, to do some estimate of the profit, understanding how the profit or the CSM is moving. So that could be helpful as we move into the new framework. And now coming to the last page on the timeline. In February, we are going to have our annual conference. In that conference, clearly we are going to provide the outlook for 2023, and the outlook for 2023 is going to be based on IFRS 9 and 17 for sure. Then on March 23, we are going to have the annual reports disclosed, and in that annual report we are going to have the opening balance sheet for IFRS 9 and 17, and that's the opening balance sheet for January 1st, 2022. And then when we are going to have our meeting about Q1 in May 2023, then we're going to show clearly the Q1 results based on IFRS 9 and 17, but we're going to show also the financial statements for 2022, so the 2022 results based on IFRS 9 and 17, so which means our meeting in May next year is going to be a little bit longer, so we're going to have to run to the explanation for 2022 and also for Q1 2023. And with that, I would like to open up to the questions you might have.
Okay, thanks, Giulio. One quick comment from my side before we move to the Q&A session. I've been told that we experienced some technical issues at the beginning of the transmission, that some of you may not have had sound for the first couple of slides. First of all, apologies for this, of course. And second, we will try to fix this if it comes to the recording of the call. So if you want to listen to the call later, please go back to the recording. And I think we were fine in the YouTube channel anyways, so this would probably be the quickest way to go back to Giulio's comments regarding the first couple of slides. So again, apologies for this, but now we come to the Q&A session, and we will take our first question from Andrew Sinclair from Bank of America. Andrew, please go ahead, your line is open.
Thank you. I really appreciate the presentation. 3 questions from me as usual, if that's okay. Firstly, was just on the 95 billion figure, shareholders' equity plus CSM or net CSM in IFRS 17 world. Just really wondered if you can give me kind of a waterfall between that and the 81 billion Solvency II own funds. I suppose particularly given that the own funds figure also includes qualifying debt, which won't be in the shareholders' equity or CSM. Just if you can walk me between those 2 figures, please. Secondly, was just on the combined ratio. Just wondered if you can talk to us about the 92% combined ratio target for 2024. Now that we're moving to an IFRS 17 world, does that target still stand as it was, or does that get adjusted? Just how should we think about that? And thirdly, apologies if you missed this. Sorry if you said this and I missed this, but just in terms of reserve releases, what should we be expecting in an IFRS 17 world in terms of reserve releases? Thanks.
Thank you for your question. So starting from the first question and the kind of reconciliation from the 80 billion to 95 billion, there are a few items that you need to consider. For example, under for 86 billion, I would say from Solvency II to the 95 billion of IFRS 917, there are a few items you need to consider. In Solvency II, all the intangible are not considered, so you need to add the intangible. Then, yes, you have the subordinated debt, but on the other side, you have also the dividend accrual that is deducted from Solvency II, but is not clearly deducted from the IFRS 9 and 17. So when you do all the calculation, we'll not go now in the call through the plus and minuses. We did the validation. We come to a number which is very close to 95. So depending, because it's doing the validation can be tricky. You need to do a lot of calculation. We end up to a number which is very much in line with 95, or sometimes when we do the validation another way, we end up with a couple of billion, 2-3 billion less of Solvency II on fund compared to the 95. So the two numbers are extremely close, and depending how you try to do this validation between the two numbers, you might get to an identical number or just to a little bit of a lower Solvency II on funds compared to IFRS 9 and 17, but the magnitude is extremely similar. There on the difference between Solvency II and IFRS 9 and 17. Then on your question about the targets, I would say that fundamentally, we can think about the combined ratio on an undiscounted basis, and then subject to the amount of rates that we're going to have in 2024, this number can be higher or lower. As of now, we would expect the number to be lower because of the rate level, but if things are changing, we might end up being back at the same level. Fundamentally, I would say that if you think on an undiscounted basis, there is not really a difference in the way we are thinking about the target. Now, then we can have always a conversation about business performance, all these kind of things, but that's a completely different conversation. Just because of the discounting, I would say, as on now, I would tell you the combined ratio will be lower, but things can change very quickly. I just tell you that if we had introduced Solvency IFRS 17 2 years ago, the conversation would have been different from the conversation we have now from the point of view of the impact of implementing IFRS 17. So things can move very quickly. Now we believe rates are going to be high forever. Maybe next year we are going to be back to zero interest rates, and then we are going to speak about the transition from one accounting to the other in a different way. On the reserve releases, this doesn't change our reserve releases. The only thing that you're going to see, because at the end of the day, nothing changes in the fundamental of the business, in our reserving basis. The only thing you're going to see is that the risk margin is somehow, there is an unwinding on the risk margin in the runoff, which is basically increasing the runoff that you're going to see, but we are going clearly to provide some information so that you can appreciate what is really the runoff, excluding the impact of the risk margin. But fundamentally, there is no change in the way we are setting reserves. We have always had the identity between the reserves that we are holding under Solvency II and the reserves that we are holding under IFRS. So clearly, this identity is going to stay with the new approach, so there is no difference for us. And then clearly you have the discounting, you have the risk margin, but there is no difference in the technical provision from an undiscounting point of view.
Super helpful. Thank you very much.
Welcome.
All right, thanks, Andrew. And we will take the next question from Michael Huttner from Berenberg. Michael, please go ahead. Your line is open now.
Thank you so much. I'm really sorry, Giulio. I didn't understand your answer. I'm really, really sorry. But maybe there you are. I make my normal plea. I'm getting really old now, so I need to be explained very slowly. I think the answer you gave to Andrew Sinclair on the technical provision and the unwind is just far too quick. I couldn't work out what was happening there. If you wouldn't mind just going through step by step, that'd be really so helpful. And then the only other question I had is why the timeline difference? You noted yourself as going to cause a headache, but I don't think you understand the headache it causes here on this side. Effectively, you're going to give us a target for 2023, and we will have no comp to judge the target when you set it on the 17th of February until the 12th of May. So for 3 months, we have to guess. I mean, we normally have to guess, but this seems such a long time. I just wondered whether you could maybe help us out here a little bit. Thank you.
So the first question on the technical provision, the question was whether we're going to see different reserve releases under IFRS 17 versus current IFRS. No, so we're going to add the same reserve. We had the same amount of undiscounted reserves, so you're going to see the same amount of runoff. There is no difference because of going from IFRS, current IFRS to IFRS 9 and 17. The only thing is there is the risk margin, and the risk margin, when there is an unwinding of the risk margin, which is a positive number. This positive number is going to go through the runoff. So we need then to be able to tell you, look, so the runoff is going to be higher, but we need to show you if we remove the risk margin from the runoff, this will be the equivalent runoff that you saw in the past. Then you need to consider that you have a risk margin going through the accident year. So you have a risk margin going through the accident here. So this is basically, if you want, increasing the loss ratio. And then you have the release of the risk margin coming from the past. And this is bringing up the positive runoff. Or net, you get to the same point. Was clear?
Yeah, that's very clear. And allied to that point, at the beginning, I think you said the combined ratio, because the denominator is bigger, would be higher. And I was thinking, no, if the denominator is bigger, this number should be lower. But I think I missed something here.
Yeah, you need to do some Excel spreadsheet. I tell you something, I had a love affair on the weekend with an Excel spreadsheet, and that's the best way to understand the mechanic. But think about that. The best way, let's say that you have a positive underwriting results. And the underwriting result doesn't really change. Forget about discounting. The only things you are changing is basically you go from a net premiums earned basis to a gross earned basis. If the underwriting results is always the same, right? Because fundamentally that's always the same. It means that the underwriting results divided by the denominator is lower, the ratio. The combined ratio is the reverse of it. So think about that,
Yes, makes sense.
Yeah, but do Excel.
Yes, absolutely.
You need Excel to help you out to visualize a few things. Yeah, and then on your question about May, and that you're going to have a very tough May. Look, I first of all, I would say the comparability of Q1 2023 versus Q1 2022 might be limited. You need to take everything with a grain of salt, because we are going from one accounting standard to another accounting standard, but we are managing still based on the current accounting. So from that point of view, I would say comparability might be a little bit more limited first. I believe we are going to be able to give you enough information to come up with a good estimate, understanding the business. We are going to have time from here to there to discuss these numbers again and again. When we do the outlook in February, we can have another conversation about the numbers. So I'm pretty confident that we are going to be able to give you all information you need in order to do your job. I have no doubt about that.
Thank you very much. Thank you, Giulio.
Welcome.
Thanks, Michael. We will take the next question from William Hawkins, KBW. Will, please go ahead. The line is open now.
Hi, can you hear me?
Yes, very well.
Great, thank you. Thanks for the presentation, Giulio, and to your colleagues for the hard work behind it. Could you help me clarify a couple of your remarks from the presentation? The calibration of the risk adjustment relative to the risk margin, roughly speaking, how have you based that? And I think you said that it's going to be slightly lower. Could you help me just be a bit more precise? I think the risk margin for Solvency II is 7 billion. So if it's slightly lower, are we talking 5, or have I misunderstood? And then secondly, similar clarification, please, on the other comprehensive income. I think you said considerably lower than 17 billion, but 17 billion itself is a big number. And, other companies have actually showed that it could be a negative OCI. So could you help me sort of slightly clarify what the OCI is in your 60 billion of shareholders' funds? And then lastly, please, because those are quite nerdy questions, if this isn't enough, why can you not apply the variable fee adjustment to Allianz Life? Because it seems at the end of the day, these rules have become so slack that you can do almost whatever you want. So I don't really see why Allianz Life can't be captured by the VFA like any other business. And I know you always say accounting doesn't matter, but if this is going to be something that generates volatility in the future, even headline accounting volatility can be a nuisance. So, is there a risk that at some point this affects the way you look at a perfectly decent business?
Yeah, so thank you for the question. On what kind of accounting standard we are applying for Allianz Life, I have the head of accounting here. Somehow there are rules, so we cannot unilaterally decide what kind of bucketing we are going to use for Allianz Life. There is also a point because variable annuity is under the VFA method, but somehow reflecting what is going to go into OCI versus CSM versus operating variance, it's also dictated somehow by the accounting rules. So from that point of view, there is some volatility which is staying with Allianz Life. One could also say this is volatility which is also reflective of some economics, because fundamentally if the hedging costs are going up and down, you're going to have more or less profit at Allianz Life. So from that point of view, I would say it's based on the accounting principle that we need to adopt, and to a certain degree we need also to accept that there is some volatility in Allianz Life coming from for example, from the hedging cost of VA. I agree with you, the real volatility is less compared to what the accounting standards usually are kind of describing. So that's on Allianz Life. On the OCI, I can tell you the OCI that we have in the 60 billion plus is about 2-3 billion. So that's the number. So it's a very tiny number compared to the 17 billion that we had under IFRS 4. And then on your question about the risk margin difference, in reality here we have used German precision because the difference between the risk margin of Solvency II and the risk margin that we have under IFRS is like 0.5, something like that. It's a very tiny number. We need, however, to consider that there is also a little bit of a different scope, because in the case of IFRS 17, we have also the risk margin on Allianz Life. When we do Solvency II is calculated with the equivalence. So from that point of view, there is no risk margin in the Solvency II calculation because it's coming anyway with a different accounting standard. But when you look at the balance sheet and you look at the difference between the risk margin that we have in Solvency II and what we have in IFRS 17, in reality we are speaking of a rounding with basically the same number, rounded up or rounded down.
Super helpful, thank you.
Welcome.
Thanks, Will. We will take the next question from Andrew Ritchie, Autonomous. Andrew, please go ahead. The line is open.
Well, hi there. Thanks for the presentation. First question, Giulio, just to clarify, I think you said you expected, looking at slide 20, the CSM to accrete by about 2 billion a year. I mean, that's basically just the effect of the unwind. So I guess I'd expected some of the addition from new business to exceed the release over time. I appreciate there's a present value effect here to some degree, but the hope was that the bath would gently fill up with more new business than what was being released. Do you think that would happen over time, or is there a snapshot issue that we're looking at it right now where you're not adding more than what's being released? So that's the first question. Second question, why is none of your life protection business PAA accounted? I thought you were selling standalone pure protection business. Third question, finance function. Some of your peers have talked about peer synergies with Solvency II, massive improvements in the finance function as a positive outcome from IFRS 17. Are you seeing the same thing? And could we expect some cost saves in the finance function in coming years? And the final question, I'm not sure which bits of your P&C business generate the volatility with respect to onerous contracts or the loss component. Maybe just clarify what types of contract that is. Thanks.
Okay, so sorry, one question was whether we're going to have saving in the finance function. I understood. No, we're not going to have saving in the finance function. But you are right. In the sense, yes, we should, because clearly there was an investment for implementing IFRS 9 and 17. But in our case, we are basically redeploying this budget because we are upgrading to the new accounting system. So yes, in theory, there is a saving, but we are not going to see this saving in our P&L because we are going to basically recycle the budget for the new accounting system that we're going to have up and running a few years down the road. Then on your question about the PPA for protection business, we have some cases. One would be, for example, in France, but the majority of our business is not subject to PPA after we did the analysis, but we have a couple of cases. And if you look at the VNB, that's also where we had this kind of scope adjustments because some of the business been accounted as PPA, so that's not basically included in reality in the calculation of the CSM, and then we need to bring it back when we want to do a VNB calculation. But that's a small part of our business, but we have a few cases. Then you had a question regarding the basically unwinding the CSM. Yes, I think it's a little bit of a reflection of where we are right now from a production point of view. So from that point of view, dependent on the level of production, we might see a CSM at inception, which is higher compared to the CSM release. But as of now, consider anyway that clearly this is not the most favorable environment from a production point of view. We are seeing these kind of numbers coming together, but that can clearly be different in a different environment. And then you had a question about the number of onerous contracts. In reality, we don't have many of onerous contracts. So from that point of view, so I can tell you we're speaking of if I take, for example, a company like Germany, I would say that less than 10% of contracts can be defined as onerous. So from that point of view, we don't see a lot of noise coming from this implementation. By the way, that's also consistent with the fact that usually you don't see in our case premium deficiency reserves. So that's one of the reasons why this is not a major issue for us.
Sorry, can I clarify that the CSM you're showing us on the roll forward is what period then? Is that annualized from 9 months?
Yeah, what we have here is basically this number. I would say it's basically annualized 6 months, something like that. That's what we use. But I always think we try to be illustrative here, so don't. It's a good proxy, but don't get overly precise on the number. I would say the number anyway is supposed to be closer to the upper ends and not to the lower end of the range. Let's put it this way. So
And just to check on the non-attributable cost that you deduct, is that modelled forward, or do you just capitalise the current run rate of those non-attributable costs?
Yeah, well, how much is the impact? Basically, you know, when you look at page 20, when you add this 21 to 23 billion of deduction, I would say the attributable cost is about 7 to 8 billion of that number. That was your question, right? How much?
Yeah, and it's just capitalizing the current run rate of those non-attributable costs, is it?
Yeah, that would be if you take the present value of the attributable cost that we have in the future is 7 to 8 billion. Yes.
Okay. All right. Thanks very much.
Welcome.
All right. Thanks, Andrew. We will take our next question from Dominic O'Mahony from BNP Paribas Exane. Dominic, please go ahead. Your line is open.
Hello, folks. Thanks for taking questions. Thanks also to, I'm sure, the legions of people who've been working on this topic. If I can just start off with, Giulio, your near final comment about Asia. I had been under the impression that cash flows from Asia are a function of local capital, and the local capital was on local stat accounts, which tended to be sort of in parallel to IFRS. Are you saying that you're expecting some of those countries to use IFRS 17 as the basis for capital, regulatory capital, and so actually cash flows will be linked to IFRS 17? I'd love a bit more detail on that if you can share it. Second question, back to page 20. I'm a bit embarrassed to ask this, but is the CSM the discounted value of future profits? On my understanding, actually, if you invested in assets yielding the discount rate, and if everything went to plan, then actually the CSM would manifest in profits, but it wouldn't be the discounted future profits. It would just be the sum of future profits. Is that right, or actually is it the discounted profits? And then last question, just on page 16. I'm surprised that the investment income remains so high in P&C. Again, in my understanding, the investment return that remains in P&C is essentially the bit of credit spread that isn't in the discount rate, and any excess in risk asset return, equities and fixed income above the discount rate. It looks here like there's only a small amount being deducted. So I wonder if you could help us understand why so little is being deducted. Thank you.
Okay, so I'm not so sure I understood the second question, but I go with the first, I go with the third, and then maybe you ask me again. I give you an answer to the second question, but I might not give you the answer you're looking for, and then you can tell me whether I understood the question or not. So starting from the number one question regarding Asia, it's not so much that the calculation of the solvency in Asia, the solvency requirement in Asia is going to change, or the way they are measuring maybe the own fund of the solvency, the local regulation, but you might have restriction on paying dividend based on the amount of local profit. So one thing is the solvency calculation, but there are again and again restriction on how much profit you can pay based on the local profit. And when Asia is going to implement IFRS 17, they should be 2025, depending on the country or later, then IFRS 17 is going to be more beneficial compared to the statutory accounting. So what we see, at least for us, we see that the dividend capacity might go up because there are less restriction coming from this local statutory cap, if you want. So that's on Asia. On the investments return, you were referring to property casualty. At the end of the day, there is no change in investment income. It's all about the discounting. And so you have this discounting, which is unwinding over time. Then clearly what we are using for the calculation of the discounting is a yield which is lower compared to the yield that we get on our portfolio to a certain degree. So there is a little bit of that element, but fundamentally nothing changes in the investment income. And then you adjust this amount of discounting and then unwinding that equalizes over time. Also, one point to consider, we have locked-in rates. So for the balance sheet, for the P&L, in reality, it doesn't really matter what is the rate level for the unwinding that you have right now. What matters is that the rate level that you had when you set up the discounting. So let's say that you set up a reserve in 2000, and there was a 5% yield, that reserve is going to unwind at 5% in the P&L. Then it's tiny in this case because it's a long time ago, but what is relevant is the amount of locked-in rate. So you need to think we are going to have years back in the past where this effective interest rate is pretty high, and then we have the latest years are going to be very low, and then you need to do a sort of average across the portfolio. And then the second question, I understood you. We are trying to understand how the CSM logic works. I would say that if you remove, I'm not so sure I understood the question, but if you remove, if you.
Would it help if I repeated, Giulio?
Sorry?
Would it help if I repeated the question?
Yes, let's repeat the question, yes.
Yeah. Sorry I wasn't clear first time. So is the CSM best understood as the present value of future profits, i.e. a discount of future profits? Or is it just a representation of these future profits? I understand the liabilities are discounted, but I'm just wondering whether the profit is discounted or not.
Yeah, so everything is discounted. Everything is discounted. You know, we actually like to discount everything, so everything is discounted and everything gets undiscounted. So in theory, if you remove the CSM at inception, what you get should be the unwinding of the discount rate, and you have the release of risk margin. So you should get basically the change in CSM plus equity should be equal to the implied cost of capital that you have in the calculation, which is a function of how you discounted all the cash flow stream, and then also the release of risk margin that would be also part of the calculation. So fundamentally, you will get back to a number which should be closer to the implied cost of capital in the calculation.
Thanks, Giulio.
Welcome.
Thanks, Tom. All right, we are already past the hour, so we will take one last question and then we will close the call. And the last question we take from James Shuck from Citi. James, please go ahead. Your line is open.
Yeah, hi. Good afternoon. So first question on the ROE target. So the above 13%. Can you just tell me mechanically what the ROE uplift is under IFRS 17, please? I think you said operating profit is similar and the NAV is lower, so just keen to see that in absolute terms. Secondly, do you expect any drag on that ROE going forward from essentially kind of the update of the locked-in assumptions? Because all the assumptions we based at the beginning of this year, and interest rates have moved a lot. So in theory, that should have some kind of drag on the ROE. The next question, and I suppose the final one, is please can you tell me what percentile you are reserving to, particularly on the P&C side, please? Thank you very much.
Yeah, no, thank you for your question. So starting from the last one, we are basically about 70 percentile on the property casualty side. Regarding your question about there is a drag in ROE because of the lock-in rate, all these kind of things. In reality, the balance sheet, is assets and liability are moving. So from that point of view, you have less of a volatility coming from the movement of the balance sheet, and then from a income point of view, I would say it's basically, eventually the profit pattern is going to be, or the amount of profit is still the same. So I wouldn't see any drag coming from the fact that we might have this locked-in rate. So from that point of view, no, I would say no drag. And then on your question regarding the ROE, at the end of the day, we expect the lift in ROE to be a good 1 percentage point. A high ROE moving forward compared to what we have been seeing so far.
Okay, thank you very much.
Welcome.
All right. Thanks very much to everybody for joining our call. We say goodbye for now and wish you all a pleasant remaining afternoon.
Thank you, guys. Have a good day. Bye.